Hi everyone, this is Dave Barnett, the CEO of Attract Capital. Today's webinar is a two-part series about what's happening in the banking industry. And we're going to talk specifically about Silicon Valley Bank. So what happened with SVB? SVB, in my opinion, was an egregious case of mismanagement on the part of senior officers of the company. They violated basic banking principles. Specifically, you're supposed to have your assets and your liabilities duration match funded. So if you have short-term liabilities, you're supposed to have short-term assets. If somebody wants their money out of the bank tomorrow, you need to have an asset that you can liquidate tomorrow in order to hand it over to them. They were the opposite. They had very short-term liability base, but they had a very long-term asset base. So they were completely not managing their duration properly. Secondly, as interest rates went up, they had most of their money in their bank on the asset side. They had it in long-term bonds. Because they had it in long-term bonds, they were losing money as interest rates went up. So they did not have a profitable way as they grew the liability side of their balance sheet, as they were accumulating more deposits. They didn't have a way to make money on those deposits by investing it in bonds. So they didn't have a way to make money. They had no earnings opportunity, which is another violation of basic banking principles. The third thing that they did was that they used hold to maturity of accounting, which allowed them to defer the earnings hit on these losses on their long-term bonds, which is something that banks have the option to do according to FASB rules. But it's a way of kind of kidding yourself. What you ought to be is transparent and take your lumps and say, this is what we lost in these securities, as opposed to being cute about it and holding it on your balance sheet for the long term. So these are basic things that SVB did. Well, why did SVB do this? Why did this happen? Well, from what I see from a lot of the banks that we deal with, the regulation that came out after the Great Financial Crisis, which was the Great Act, really regulated banks excessively and gave them a lot of new procedures and a lot of risk controls to follow. And it almost eroded the bank's ability to have original thinking and to have critical thinking about how best to mitigate the risks that they see in their business. So you can almost think of it as that banks have become expert in rule following that has been laid down by the government, as opposed to developing their own discretion with respect to de-risking. So when you use something such as hold to maturity of accounting, you're just kind of playing into the fact that you think an apple is an orange. It's sort of something other than what it really is. And so when you abdicate your basic financial analysis like this, and you basically look at it and say, we're going to call it something than what it is, and we're also not going to have our portfolio match funded. And by the way, we're not going to have a chief risk officer. And by the way, we're going to grow our liability from 80 billion to 200 billion over an 18-month period in a period of rising interest rates. You have to wonder, did they really even know what they were doing when they decided to run that bank? Because these are rookie mistakes. These are things that should never happen, because banks, and sort of the cardinal rule of banking is the way you run a bank should be all about policies supporting safety and soundness, which was completely not something that it appears SVB was following. So they violated basic principles. I think it was a function of the overregulation. And in our next webinar, we're going to talk about how this was similar to what happened in the banking problems in the Great Financial Crisis, as well as tips for what you can do about it in order to minimize the risk that you might have to this. Take care.